Class. Haven't done one of these videos for you guys in a while, so I figured I'd show you guys a little bit about the work I do, a few minutes kind of behind the scenes, give you a little bit of a market commentary on, where I see things right now. So I'm going to switch screens right here to show you guys one of my, key investment resources for data and analytics on portfolios, and that's called FactSet. This is a sample portfolio. Also just want to be clear, just because I hold the stocks here, it's not a personal buy recommendation for you. This analytics tool lets me look at a portfolio of equities kind of in aggregate. Right here in the chart on the left, those are all the absolute weights in the portfolio. Center here are the relative weights to the S&P 500. I use this as a way to control for risk. So, for example, we have a 28% position in technology, and we're about 0.8% overweight. So small overweight, and that's by design. I'll get into a little bit more about that in a second. On the right here is how things have performed for today. So, what's done the best and what's done the worst on a daily basis. I can tell right now that, today in the stock market on April 20th, we had a pretty, looks like strong value rally. So stocks that paid a dividend tended to do well today, while the growth names, HubSpot, Match, Google, Take-Two Interactive, and Revolve all lagged the market, which has kind of been the trend, switching to a little bit of macro commentary. Since the start of the year, really since November, where we had that one last big growth rally, and values really won the day since then. So stocks that pay investors today in the form of dividends. Speaking of dividends, I keep track here. The portfolio pays a dividend of about 1.5%. That's pretty similar to what the S&P 500 pays. As a barbell approach there, I have some names like Verizon here or AT&T that pay close to a 5% dividend. And then, I have names like Match.com and Take-Two Interactive, which don't pay investors anything today. That's a big part of the process. So I can dive into here and look at individual companies, see what news they might have. Hasbro is a relatively new addition to the portfolio. Again, I like it because it pays a 3.1% dividend, on top of looking cheap. LGI Homes, something that's pretty beat up recently. You can see it's down 25% in the last month and about 42% in the last year. Thinking being home builders are under pressure. One key metric I usually look at, PEG ratio. Anything below 1 is a deep value, considered deep value. Well, this is a growth stock. It doesn't really pay any dividends, but the PEG ratio actually puts it in the deep value bucket for me. What is the PEG ratio? Price to earnings divided by growth expectations of Wall Street analysts. It helps normalize a PE ratio, makes it comparable to other ones. Again, home builders look super cheap here. It's saying that, hey, even with high or rising rates, the home market is not going to putter out. That's what the signals are telling me. Another thing here is the ranking. I outsource some quantitative work, which basically analyzes stocks, ranks them 1 through 10, 1 being buys, 10 being sells, and then, in the middle being holds. So scroll through here, let you see a little bit more of the portfolio as it stands today. And that was about it. This is also some news headline information. I can see what's going on in my portfolio, on my watch list. Coca-Cola here has been a recent add to the portfolio as well. Again, I like it because of the strong dividend. Among other kind of macro reopening factors, one thing I'll mention too is, Coke and Pepsi are actually pretty different. Pepsi has a much bigger snack business. So that's more of a stay-at-home play in my eyes compared to Coca-Cola, which is more of a bar, restaurant, stadium exposure. So hope this video was helpful. Feel free to ask me any questions that you might have, and looking forward to talking to you guys soon.